You know that moment when you check your investment account and somehow you made more money while you were asleep than you did working all day? That right there is the snowball effect. And once it starts rolling, your financial life never looks the same again. In this video, I'm breaking down the exact timeline, the real numbers, and the 3 stages everyone goes through. Plus, I'll show you exactly what to do at each stage so you don't quit right before things finally take off. By the end, you'll know how to trigger this effect in your own life, no matter where you're starting from.
What's up, everyone? Here's the part about the snowball effect that almost nobody talks about. It's not just about money making money. It's about understanding the 3 specific stages your money goes through before it starts working harder than you do. And in this video, I'm going to walk you through each stage, show you the real numbers, and give you a clear blueprint to activate this in your own financial life. But let's get one thing straight right away. This is not a get-rich-quick scheme. This isn't about picking the perfect stock, timing the market, or chasing some secret investing hack. This is about turning on a mathematical certainty that's been working for hundreds of years. The same force that built the Rockefeller fortune, the same principle Warren Buffett used, the same system quietly creating millionaires while they sleep. And here's the crazy part. Most people never activate it. Not because they can't, but because they quit too early. I will be sure to show you why.
Here's what usually happens. You read about compound interest. You watch a video like this. You get fired up. You open an investment account and start putting in $100, maybe $200 a month. Month 1 feels amazing. You're investing. You're being responsible. You're building wealth. And then, nothing feels different. 6 months go by. You check your account, and sure, you've saved around $1,200 and maybe earned, what, $30 in returns? Nice, but that's not life-changing. That's one decent dinner out. That's not the money working while you sleep dream everyone talks about. So you wait longer. After a year, you've invested about $2,400, and your account says $2,480. Congrats, you made $80. Meanwhile, some guy on Instagram is talking about flipping houses or day trading crypto and making $10,000 in a week. So what happens? You get discouraged. Maybe you stop contributing as much. Maybe you pull money out. Or you start hunting for something better, higher returns, faster results, some shortcut. And here's the brutal truth. The snowball effect doesn't feel like anything until suddenly it feels like everything. Most people quit right before the magic happens. They're stuck in what I call the dead zone, that stretch where you're doing everything right, but the results feel tiny compared to the effort. It's like planting an oak tree. You water it, you protect it, you take care of it, and for the first few years, it's barely taller than you are. You could walk right past it and not even notice it. But you don't plant an oak tree for shade in 5 years. You plant it for the forest it becomes in 50. The problem is, we live in a world of instant gratification. We expect our money to work like our phones. Instant results, constant updates, little dopamine hits all day. But building wealth runs on a completely different timeline. And if you don't understand that timeline, you'll quit during the most important phase. Let me show you exactly what I mean with real numbers. And I promise, once you see this, you'll never look at your investments the same way again.
Stage 1. The grind. Years 1 through 3. This is where about 90% of people are. And it's also where about 90% of people quit. You're putting in your own money every month. You are getting returns, but let's be honest. Your contributions are doing almost all the heavy lifting. It feels like you're just moving money from your checking account to an investment app. Let's say you invest $500 a month and earn an average of 8% per year. Year 1, you put in $6,000 of your hard-earned money. Your returns? About $250. Total account value? $6,250. Think about that. You worked all year, you sacrificed $500 every month, and your passive income for the year was $250. For most people, that's less than a day's pay. Year 2, you put in another $6,000. Returns on your bigger balance? Around $1,000. Total account value? $13,250. Better, but you still contributed 6 times more than your money did. Year 3, another $6,000 goes in. Returns, about $1,900. Total account value, $21,150. So after 3 full years, you've put in $18,000 and your investments have earned around $3,150. This is the grind. Your returns are still less than what you contribute in just a few months. This is where people think, this isn't working. I get it. I've been there. I remember checking my account in year 2 and feeling like I was missing out on something better. But here's what I didn't understand back then. I wasn't building wealth yet. I was building the machine that would build wealth. Every dollar you invest early on is like loading a cannon. It feels slow. It feels boring. It feels like nothing is happening. But now, watch what happens next. Stage 2, the tipping point. Years 4 through 7. This is where things start to shift, and I mean really shift. Year 4, you still contribute $6,000. Your returns, about $2,900. Total, $30,050. Now, your money is generating almost half of what you're putting in. Year 5, another $6,000 invested. Returns, roughly $4,100. Total, $40,150. Your money just made more than 2/3 of your annual contribution while you were living your life. Year 6, $6,000 in, returns about $5,500, total $51,650. Your investments are now doing almost as much work as you are. Year 7, $6,000 contributed, returns around $7,200. Total $64,850. Pause right there. In year 7, your money made more than you contributed. For the first time, your investments worked harder than you did in this account. After 7 years, you've contributed $42,000 and your investments have generated about $22,850. This is the tipping point. Your money isn't just along for the ride anymore. It's a contributor, and it's just getting started. If you're in years 1 through 3 right now, you might be thinking, great, so I have to wait 7 years? 2 things. First, your money is working the whole time. You just can't feel it yet. Second, those early years matter most because they build the habit. People who win don't need to see results immediately. They trust the process before they see the proof. Now, let's go to the fun part. Stage 3, the snowball. Year 8. This is where math starts to feel like magic. Year 8, you contribute $6,000. Your returns, about $8,700. Total, $79,550. Now, your money is the senior partner in this relationship. Year 9, $6,000 in, returns about $10,400. Total, $95,950. Your investments are making almost double what you're putting in. Year 10, $6,000 contributed, returns around $12,300. After 10 years, you've put in $60,000 and your money has made about $54,250. And now the curve really starts to bend. Year 15, returns that year alone about $23,000. Total, $216,100. Year 20, returns that year about $42,000. Total, $329,850. In year 20 alone, your money made 7 times your annual contribution. You put in $120,000 over 20 years. Your money made about $209,850. And it keeps accelerating. Year 25, returns that year about $71,000. Total, $527,650. Year 30, returns that year about $117,000. Total, $814,850. You contributed $180,000 total. Your money made about $634,850. That's the snowball effect fully activated. And remember, this example used 8% returns, which is historically conservative for a broad stock market index. At 10%, the numbers get even wilder. But here's what really stops people. When you're in year 2 looking at $13,000, your brain cannot emotionally grasp what $800,000 feels like, so you don't believe it's real. And that disbelief is what kills the snowball before it ever gets rolling.
So, what's actually going on here? Why does this snowball effect even exist? It's not magic. It's 3 simple mathematical forces working together. 1. Compound interest on compound interest. This is the engine behind everything. Your returns start earning their own returns. Here's what that really means. In year 1, you invest $6,000 and earn 8%. That's $480. Nice. But in year 2, you're not just earning 8% on your new $6,000. You're earning 8% on your new $6,000, your original $6,000, and the $480 your money already made. That $480 now has a job. In year 2, it earns about $38. Then that $38 starts earning money in year 3, and those earnings start earning. It's like a family tree of money. Every dollar you invest has kids. Those are your returns. Then those kids have kids, and it keeps going. By year 20, you're not just earning returns on the $120,000 you put in. You're earning returns on the $200,000 plus your money has already created. That's compounding. Growth on top of growth on top of growth. People love to quote Einstein, calling it the 8th wonder of the world. Whether he said it or not, the idea is dead on. It's the closest thing to magic in finance. 2. Time does the heavy lifting, not money. Here's something that sounds fake but isn't. The difference between good investing and great investing is often time, not higher returns. 2 people. Person A invests $500 a month from age 25 to 35, then stops completely. Person B waits until 35, then invests $500 a month all the way to 65. At 65, Person A ends up with about $1,018,000. Person B ends up with $745,000, even though Person B invested 3 times as much money. Why? Because Person A gave their money 10 extra years to compound. 10 more years of growth beat 20 extra years of contributions. That doesn't mean you should stop investing early. If Person A kept going, they'd have way more. But it shows the real driver here. Time is more powerful than the amount. This is also why Warren Buffett's wealth exploded later in life. He didn't suddenly become a genius at 50. His snowball had just been rolling since he was a kid. 3. Your behavior matters more than your returns. This one's not sexy, but it's huge. You know what beats a 12% return? An 8% return that you actually stick with. Some people chase better investments nonstop. They jump in after something runs up, panic when it drops, sell, miss the recovery, then chase the next thing. Meanwhile, their boring friend just buys index funds every month and ignores the noise, and quietly wins over 10, 20, 30 years. Consistency beats optimization, every single time. There was a famous study, I think from Fidelity, that looked at which investors had the best long-term performance. You know who did the best? People who forgot they had accounts, and people who had passed away. Seriously. Because they didn't panic. They didn't sell in crashes. They didn't try to time everything. They just left it alone. Your ability to keep investing when markets drop, to not pull out when you're scared, to not chase hype when you feel FOMO,
That matters more than finding the perfect investment. The snowball effect doesn't reward genius. It rewards discipline.
All right, so how do you actually turn this snowball on in your own life? Here's your blueprint. Simple, practical, and built for real humans, not finance robots. Step 1. Automate your contributions, non-negotiable. Set up automatic investing for the day after you get paid. I don't care if it's $50, $100, or $500. What matters is that it's consistent and sustainable. Don't be the hero who invests the $1,000 a month for 3 months, then burns out and quits. That person usually ends up with less than the one who quietly invested $200 a month for 10 straight years. Here's the sweet spot. Your contribution should feel a little uncomfortable, but not stressful. If you don't notice it at all, you can probably invest more. If you worry about bills, it's too much. And here's the psychological trick. Pay yourself first. Don't wait to see what's left at the end of the month. There will never be anything left. Life expands to use whatever money is available. Instead, your investment leaves automatically right after payday. You live on the rest. Within a couple of months, your brain adjusts. That money stops feeling like it was ever yours to spend. Step 2, use index funds. Keep it simple. Complexity is what derails most people. You do not need to pick stocks. You do not need to read charts. You do not need to watch financial news every day. A few low-cost index funds will outperform most professional investors over long periods, and they require almost zero effort. For most people, it's as simple as 1. 3-fund portfolio, 60 to 70% total U.S. stock market, 20 to 30% international stock market, 10 to 20% total bond market. Option 2, 1-fund simplicity, a single target date retirement fund. That's it. No stock picking, no market timing, no clever tricks. Why this matters for the snowball? Fees compound too. A 1% annual fee versus 0.05% might not sound huge, but over decades, it can cost you tens of thousands of dollars. That's money that could have stayed in your snowball. Low-cost index funds keep more of the growth working for you. Step 3, survive the dead zone, years 1 through 5. This is where most people fall off. Your account is growing, but it feels slow, and you'll face 4 big temptations. Temptation 1, stop contributing. It's not growing fast enough. Every skipped month delays the snowball. Time is the secret ingredient. Don't interrupt it. Temptation 2, pull money out for a car, a trip, something you really want. If it's a true emergency and you have no backup, okay, but be honest with yourself. That $5,000 you pull out in year 3 isn't just $5,000. Over decades, it could have turned into many times that. You're not spending today's money. You're spending future growth. Temptation 3, chase hot investments. Crypto hype, options trading, a friend's can't-miss business. Some people get lucky, most don't, and even the lucky ones often give it back. The snowball isn't exciting. It's steady, predictable, a little boring. Boring is beautiful when it builds wealth. Temptation 4, compare yourself to others. You see someone online with a $500K portfolio while you're at $15K and feel behind. You don't know their timeline, their income, their inheritance, or even if they're telling the truth. Your only competition is your past self. If you're further ahead than last year, you're winning. How to survive this phase? Check your account quarterly, not daily. Celebrate the habit, not the balance. Focus on how much you invest, not what the market did. Remind yourself, every boring month is fuel for the snowball. Step 4, increase contributions over time. This is how you speed everything up. Every time you get a raise, increase your investments too. Get an extra $200 a month? Send $100 of that to your investments. You still feel richer and your future jumps forward. Other easy wins: pay off a car, redirect that payment to investing. Finish student loans, redirect it. Work bonus, invest a big chunk.
Side hustle income? Invest most or all of it. Small increases over time can add up to hundreds of thousands of dollars later. You're not just growing the snowball, you're pushing it downhill faster. Step 5. Don't touch it. The golden rule. Life will tempt you to dip into your investments. That's why you need an emergency fund first, 3 to 6 months of expenses in cash. That buffer protects your snowball from getting cracked open every time life happens. Because every time you pull money out, you're not just losing that amount, you're losing all the future growth it would have created. Breaking the snowball early has a hidden long-term cost. So build your safety net, then treat your investments like they're off limits. Because in a way, they are.
All right, this part right here is what really changed everything for me. Because you can understand all the math, you can know how compounding works, but if your mindset is off, you'll still quit. Here's the shift I made. I stopped thinking of my investments as money I'm giving up. I started seeing them as employees that work for me 24/7. Think about it like this. Every $1,000 you invest is like hiring a worker that generates about $80 a year at an 8% return. And this worker never quits, never sleeps, never asks for a raise, never complains, works weekends, works holidays, works while you're on vacation. After 10 years, that $1,000 worker has turned into about $2,100. One worker just became two. After 20 years, that one worker has turned into the equivalent of 5. When you see it this way, every dollar you invest is building your personal workforce. And eventually, that workforce starts making more than you do at your actual job. Here's another mental model I love. Investing is how you buy back your future time. When you invest $500 this month, you're not losing spending money, you're buying freedom. Using a common retirement rule of thumb, every $10,000 invested can eventually support around $400 per year of income. So consistent investing over time can translate into thousands of dollars per year that your money generates without you working for it. That's weeks of your life each year that you don't have to trade for a paycheck. That's not a sacrifice, that's a trade, and it's one of the best trades you could make. One more reframe. Your job is linear. 1 hour of your life equals 1 hour of pay. Investing is exponential. You invest once, and that money can work for you for decades. You make a one-time effort, and you get years and years of return. That's not an equal exchange. That's a massively unfair advantage in your favor. Once that clicked for me, I stopped seeing investing as a restriction. I started seeing it as opportunity. And here's the final mindset shift. Building your snowball is a form of self-respect. When you invest in your future, you're saying, my future matters. I matter. My life later on is worth planning for. Too many people treat their future self like a stranger, like someone else will deal with it. But your future self is still you. One day, you're going to be 60 or 70 looking back at the choices you're making right now. What do you want that version of you to feel? I wish I had started, or I'm so glad I did. That decision doesn't get made someday. It gets made today.
All right, let's talk about the landmines, the things that can wreck your snowball before it ever really gets rolling. I've seen people make these mistakes. I've made a couple myself. Learn from them. Mistake number 1, waiting for the right time. I'll start when I make more money. I'll start after I pay off everything. I'll start when the market drops. I'll start when I understand it better. No. The best time to start was years ago. The second best time is today. Here's what waiting really costs. Start investing $500 per month at 25 versus 30, assuming 8% returns. Start at 25, about $1.7 million by 65. Start at 30, about $1.1 million by 65. Waiting 5 years doesn't just delay you, it can cost you hundreds of thousands of dollars in future growth. And here's the truth. The market will always feel uncertain. Life will always have other expenses. You will never feel fully ready. Start anyway. Start small if you have to. Just start. Mistake number 2, trying to time the market. The market's too high, I'll wait for a crash.
That sounds smart until the market goes up another 20% while you're waiting. Then it drops 10% and it's still higher than where you first hesitated. Or it does crash and you're too scared to invest because it might go lower. Market timing traps you in indecision. Instead, use automatic, consistent investing. Same amount every month. Up market, down market, boring market. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, it averages out, and you stay out of emotional decision-making. Consistency beats guessing. Every time. Mistake number 4. Comparing your Chapter 2 to someone else's Chapter 15. Social media is brutal for investors. You see someone flexing a 500K portfolio while you're sitting at 12K, wondering if you're behind. But you don't know how long they've been investing, how much they earn, whether they inherited money, whether they're leaving out debt, whether they're exaggerating. Comparison kills motivation, and motivation is what keeps the snowball rolling in the early years. Your only real comparison is you from last year. Are you investing more? Are you more consistent? Are you learning? Then you're moving forward. That's what matters. Mistake number 5. Obsessively checking your account, especially during market drops. If you check daily, you'll see red days, a lot of them, and your brain will start whispering, should I sell? Is this the crash? Am I losing everything? That emotional spiral leads to bad decisions. Try this instead. Monthly, make sure your contribution went through. Quarterly, look at your overall progress. Annually, review your allocation if needed. The more often you check, the more chances you have to panic. Patience is a huge part of winning. Mistake number 6. Skipping the emergency fund. This is a silent snowball killer. Life will happen. If you don't have cash set aside, you'll be forced to pull money from investments right when you shouldn't. Before investing heavily, build a cushion of 3 to 6 months of expenses in a savings account. It's not exciting, it's not high return, but it protects your investments from being interrupted every time life throws a punch. Mistake number 7. Investing money you'll need soon. Never invest money you'll need in the next few years. The market goes up long-term, but short-term, it can drop hard. If you need money for a house down payment, wedding, or big purchase soon, that money belongs in safe savings, not stocks. Investments are for long-term goals. Savings are for short-term needs. Match the tool to the timeline.
Before we wrap up, I need to get real with you for a minute. The snowball effect is not exciting, at least not for the first 5 to 10 years. It's boring. It's repetitive. It's watching small numbers grow slowly while everyone around you seems to be getting rich quick with crypto, NFTs, day trading, real estate flipping, or whatever the hot thing is. You will feel behind. You will feel like you're missing out. You will question whether this is actually working. And that's the test. Because the snowball effect doesn't reward the smartest people. It doesn't reward the luckiest people. It doesn't reward the people with perfect timing. It rewards the people who show up, month after month, year after year, through bull markets and bear markets, through recessions and recoveries, through doubt, fear, and boredom. The people who win this game are the ones who are still playing in year 15, year 20, year 25. And here's what I've learned. The difference between people who build wealth through investing and people who don't has nothing to do with income. I know people making $200,000 a year with nothing saved. I know people making $45,000 a year who are millionaires. The difference is discipline. The difference is consistency. The difference is understanding that boring beats exciting over time. So if you're watching this and you're in year 2 of your investing journey feeling discouraged, I need you to hear this. You're exactly where you're supposed to be. The people in year 15 who are crushing it, they felt exactly like you do in year 2. They had the same doubts, the same frustration, the same temptation to quit. The only difference between you and them is they didn't quit. So don't quit. Look, the snowball effect isn't magic. It's math. Boring, predictable, reliable math. But here's what's beautiful about it. It doesn't care about your background, your starting point, or how much you make.
A teacher investing $300 a month for 30 years will activate this effect just as surely as a software engineer investing $1,500 a month for 15 years. The principles are the same: consistency, time, compound growth. You're not too late, you're not too behind, you're not too broke. You're exactly where you need to be to start today. I don't care if you're 22 or 42 or 62. I don't care if you can invest $50 a month or $5,000 a month. I don't care if you know nothing about investing or if you've been doing it for years. The best time to activate your snowball was yesterday. The second best time is right now. So here's my challenge to you. Before you click off this video, I want you to take one action. Just one. It could be opening an investment account if you don't have one, setting up your first automatic contribution, increasing your current contribution by even $25 a month, moving your money from a high-fee fund to a low-cost index fund. One action. That's it. Because the snowball effect doesn't start when you have money. It doesn't start when you understand everything. It doesn't start when conditions are perfect. It starts when you take action. And then it starts again next month, and the month after that, and the month after that, until one day, maybe in year 7, maybe in year 15, maybe in year 20, you wake up and realize your money is making more than you are. And that's when you understand. You didn't just build wealth, you built freedom. If you found this helpful, hit that subscribe button. I break down financial concepts like this every week, and I want to help you build wealth without the BS. Drop a comment and let me know. What stage are you in right now? Are you in the grind, approaching the tipping point, or already riding the snowball? And what's the one action you're going to take today? The comment section is full of people on this same journey. Share your story, learn from others, support each other. Because here's the secret nobody tells you. The hardest part of building wealth isn't the strategy. It's the loneliness of being disciplined while everyone around you is spending. But you're not alone. There's a whole community of people doing the same thing, building their snowballs, trusting the process, playing the long game. And we're all going to win. I'll see you in the next one. Now, go activate that snowball.